From downtown Milwaukee, welcome to Money Talk with Bob Landaas. Each week, professional advisors from Landaas & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk from March 14th, 2025, and here's what's happening. The St. Patrick's Day Parade steps off in downtown Milwaukee tomorrow at noon. The Brewers are wrapping up spring training games before the home opener on the 31st. But the regular season continues for the Milwaukee Bucks. They host the Indiana Pacers tomorrow and the Oklahoma Thunder on Sunday. Then they hit the road for a week. And for something a little different, there's drag bingo at Pop in Walker's Point. I think that would be a hoot. Well, the trade war is on, but leave it to the Canadians to come up with a remedy. Moosehead Breweries of Canada is selling the presidential pack. That's not a six-pack, but it's one beer for every day left in Trump's second term, or 1,461 beers. You're going to need help getting that into your truck. One more border story. At the Canadian and Mexican borders, the U.S. is making more seizures of illegal drugs, of illegal eggs, than fentanyl. The score is 3,767 seizures of eggs compared to 352 seizures of fentanyl. And I bet the eggs are still cheaper. And finally, police say they discovered what started one of the wildfires on Long Island. It turns out a kind-hearted dad was making s'mores for his kids in the backyard barbecue pit. Well, you know the rest. They may never eat s'mores again. On the podcast today, we have John Sandstrom, Steve Giles, Joel Driesing, and wrapping up the week, here's Kyle Teding.
Well, thanks, Max, and not lost on me as we talk about some of these stories from Canada that you're sitting there drinking a Canada Dry Ginger Ale. So very much on brand for the week. A tough week, however, for markets. NASDAQ down 2.4%, down 442 points, closing at 17,754. The S&P down 2.3%. That's 131 points on the week, closing at 56.39. And the Dow Jones Industrial Average, despite adding 675 points on Friday, down 13.14, 1,314 points on the week to close at 41,488. That's, again, down 3.1% for the year. Down now in negative territory, down 2.3%, including dividends. The S&P down 3.9%. The NASDAQ, a pretty intense down 8% to start the year. Steve, I think we'd be remiss if we didn't mention that Thursday marked correction territory, at least officially or technically, for the S&P 500. I guess the kind of first thing I always expect anytime we reintroduce this conversation, and maybe we jump into this as well, but it's a regular conversation, much more regular than I think we might be willing to admit, is that the typical fund families, the typical investment firms tend to roll out, okay, here's what you need to know about correction. So what are we hearing now?
Well, we're hearing a lot about corrections, Kyle, and maybe a definition here for our listeners, because it's important to distinguish the differences between maybe a correction, which is a 10% decline, a bear market, which is a 20% decline in any one indice, and a recession. Just because the market's down doesn't mean we're necessarily in a recession, and vice versa. A few statistics for our listeners that I think they might find interesting. We've actually had, since the 1980s, a 10% decline or more about 50% of those years. So for those of you that are wondering that this is something that's never happened before, it happens about every 2 years. We get a 10% correction, and that is good, Kyle, because it lets the market bleed off some of the excess. We let off some steam. We can be on more solid footing now moving forward if that excess has been let off. Think of it as 3 steps forward, 1 step back.
Yeah, I think that's fair. And John, I know you were looking a lot at some of those studies and some of that data. Anything in particular stand out to you, maybe worth bringing up to our listeners?
Well, it kind of goes along with what Steve had just said, expecting a 10% or a correction by definition every other year. And our last one, Joel and I were actually just looking at this, funnily enough, was peak in February of 2023, and it bottomed in March, which, we peaked in February of this year, and now It's been a little bit less than a month total, but we are in correction territory now. Not saying that that's the time frame we're looking at on this one. There's plenty more uncertainty here, I think, as opposed to 2023. We probably had some more concrete things that we were able to look at in that scenario than we are this time around. But I think it's important to remember that, like Steve said, these are normal and they do happen, and that's why we kind of invest the way that we invest. Obviously, equities are having a tough go the past few weeks, but fixed income is performing the way that we expect it to, and that's why we have that as a large part of our portfolios for clients to kind of help smooth out the ride.
Well, and John, one of the things you and I were talking about before the show was the fact that I think a lot of our clients have been surprised when they see returns, when they kind of see, all right, what am I actually doing this year that, it feels like there's been a lot of selling pressure, and especially from the peak there has been. And we can talk all day about how that's normal, but then when you look at your actual portfolio and we talk about the benefits of balance and we talk about the slivers of the portfolio that are actually doing okay, in particular non-U.S., well, the actual returns often a lot different than expectation.
Yeah, absolutely. And this is actually something I literally just read and was talking to Joel about before we walked in here is after market close yesterday, the Magnificent Seven stocks actually accounted for about 95% of the S&P's decline so far this year. And we're not investing 100% of your assets in the Magnificent Seven stocks. Obviously, that's a part of your portfolio, but there's a reason why we don't do that. It's for situations like this to kind of, like I said before, smooth out the ride.
And of course, we were maybe disappointed we didn't have 95% of our portfolio in the Mag 7 the last couple of years. But it is that strong reminder that it's sometimes as quick as things go up, they can come back down. And it isn't always a shift in fundamentals, right? That I think what we're dealing with right now is not some massive new understanding of where the world is headed or of kind of a fundamental shift. It's very much been a lack of fundamentals, that we don't really have clarity on where things are headed, that there is this kind of mass of uncertainty out there, which I think, has made it really easy for profit takers to take profit, while those of us that are more fundamentally driven in our investment decision-making are left to kind of just say, hey, we're going to have to wait this out. We're going to have to figure out where this goes. And Joel, I know uncertainty is a big thing you've been diving into, including a recent book by the very name. But what are we learning about uncertainty? What are you learning about uncertainty that maybe might help investors through this time?
Yeah, it's interesting, Kyle. This book takes a different angle on uncertainty and basically says it seems that we've got greater uncertainty more than ever, and that it followed up a lot of social science research that's saying that uncertainty actually, there's wisdom in being uncertain and tolerating uncertainty. And it actually reminded me of a lot of things I hear around here. Things like expect the unexpected, right? And look for opportunities. And those are the sorts of things that happen when you don't freeze up, when you're not frozen by uncertainty. When something happens that you don't expect, you don't freak out and either sell everything or just sit there numb. And it's just sort of it's behavioral economics.
Yeah, and I think we often are the folks that pound our fist on the table and yell it's all about earnings and interest rates. We're often the folks that talk about, okay, here's what the economic indicators tell us about what's going on, about where they think we're headed. And I think we have to learn to operate sometimes in an environment in which that isn't always telling the story of where we're headed. It's certainly right now, at least, I think, is a tougher conversation about, all right, we got to get through some stuff before we can get clarity on where we're headed next.
These times are also good to remind clients that just because the market is going down doesn't mean their portfolio is down as much as the market is, Kyle. For a lot of clients that are relying on income, they're in retirement, they're supplementing things like Social Security and pensions, their portfolios are already allocated in a way that is generating that income and that cash flow through investments that are not stocks or stock mutual funds. So as much as we may read those headlines that show the market is down, 6, 8, or 10%, their portfolios aren't down those percentages by any means. I am also reminded about the analogy of the farmer who is only concerned about the yield that they're getting on their crop. They're farming, and as long as they can generate the kind of yield to turn the income that they need every year, they're going to be happy. What the farmer isn't concerned about is the value of the farm. If real estate values go down and now their $1 million farm is only worth $800,000, they aren't going to decide to sell the farm just because it's worth less. They're still going to be focused on the yield. And if you liken that to your portfolio for retirement generating income, as long as you have adequate income set aside, as long as you're generating the yield that you need to meet your cash flow, why are you concerned about the value of the farm?
And Steve, what I'm also hearing there is having a plan. If you're going into something expecting the unexpected and having a plan of what you do when something unexpected happens, you've explored scenarios that you're not necessarily hoping for, but you kind of think ahead of little of what if this happens, what would I do? I think that's really useful.
Well, I think as Americans, Joel, we feel like we have to do something to feel like we're getting something in return, right? And so think about everybody that's driving on the freeway and traffic slows, and if the lane next to you is faster, you're like, I got to get in that lane. And the second you do, the lane you left is now faster. Where studies have shown that if you don't do anything and everybody stays in their lane, they're all going to get to where they need to go, and it's actually going to be faster for everybody.
Yeah, it'd be nice if we could all follow those rules, especially when I'm driving on my way home from work tonight. But, I think you all hit the nail on the head as far as having the plan going in, understanding that the role that the farm plays, Steve, in your analogy, the role that plan plays ultimately is to say, here's what happens when we're not confident in what's going to happen next. Doesn't mean we don't have some ideas about where we think it's headed. It doesn't mean that long term we don't have some expectation of what we'd like to accomplish. Yeah, we'd love for the farm to be worth more money, but we also got to figure out how do we navigate the next 3 months, 6 months, a year, and that's where the bonds come in. It's where the safer piece of the portfolio comes in. It's where diversification plays such a critical role, and it's why, Joel, having that plan really is the key. We were talking about some astronauts before the show and them being stuck up on the space station for the better part of the last 9 months. And it's not because they don't want to be there. It's not for anything else, but because something happened. And so, I think having that plan is key.
And I'm also hearing in this humility, which we talk a lot about. And the point of humility is saying, I think I know what's going to happen, but I can't know for sure. So we have to make provisions for that.
And I think that is critical, right? Being humble doesn't mean not taking action. It doesn't mean just accepting everything that gets thrown our way and never doing anything different. It does, however, mean that we have to be cognizant of what we don't know. And that sometimes there's things we don't know. And I think we are very much in that environment. We are very much learning to navigate, okay, what's it going to mean for tariffs to be on again, off again? What's it going to mean for whatever kinds of changes are coming politically that we maybe haven't even forecast yet? What's that going to mean for economic growth? What's it going to mean for markets? Clearly, we've seen some opportunity in some of that change, and we've seen risk in other areas. And so that does mean we're going to have to be nimble. It does mean we're going to have to make changes over time, reflecting areas of opportunity and risk. But it also means that maybe the first thing to do isn't just dive headfirst in, right? You got that big check from your 401k provider that you want to bring into your IRA here at Landaas. Well, we're probably going to tell you right now, hey, let's take it in a couple of steps. Because, yeah, we're pretty comfortable knowing that long term, you're going to be okay if you invest in stocks. And we certainly are getting better prices than we got 2 or 3 weeks ago. However, there's more uncertainty to come, as there always is, and perhaps we want to be able to operate in that environment for a while longer. Joel, some uncertainty in the economic news certainly this week, including some gyrations in consumer confidence, which the headlines got me again. and wanted to make sure we got that word into the podcast today. But yeah, consumers not feeling all that happy about maybe what's going on out there.
No, and this is we have a University of Michigan survey that came out today on consumer sentiment, and it's repeating what we've seen the last couple of months actually, with between that survey and the one by the Conference Board that looks at consumer confidence. And the uncertainty out there is making consumers nervous. The University of Michigan survey actually, to quote them, referred to frequent gyrations in economic policies and what that's doing to people's sense of certainty. And what we've seen in that is that the consumer sentiment has shot down 22% since the beginning of the year. And we always say, this consumer sentiment is a fickle sort of an indicator, and that a lot of times consumers say one thing, I'm not confident about spending, and then they keep on spending. But it's an indicator nonetheless that the main thing that drives the economy, which is consumer spending, might be at risk. A couple of notes. There's always uncertainty, right? Whenever we talk about uncertainty here, I'm always like, well, we're never certain about stuff. But the other one is that John and I were talking just before, overall, the indicators show that we still have a pretty strong economy. And, whether tariffs add to inflation, we don't really know yet. It didn't show up in the producer price index, the wholesale inflation number, which some economists were expecting to see something there this week when that came out, and that was for the month of February. It didn't show up in the consumer price index, which is a little farther removed from the tariffs. But in fact, the consumer price index was lower than the economists had thought ahead of time. So that was a good thing. But again, you sort of tease out pieces of that, and egg prices are up 10.5% from January, and 58% from a year ago.
Well, Joel, isn't some of the inflation numbers a bit of a self-fulfilling prophecy, if you will, where consumers and their sentiment is now low? You've got some companies, airlines in particular, that are starting to note a decline in interest in flying.
Right, yeah. One of the numbers that stood out from the consumer price index for me was that airfares went down 4% from January to February. I don't think that's happened since, I think they're now lower than they were just before the pandemic, which is interesting. But we also had 4 major airlines this week come out and say, well, our earnings aren't going to be as fat as we expected because consumers are too uncertain and they're not going to be buying airfares, so we're lowering the prices.
And yeah, I think the vicious and virtuous cycles, the kind of two versions of one, when you think bad stuff's going to happen, well, it tends to become the self-fulfilling prophecy. But likewise, when you expect the good stuff or you expect high inflation, well, all right, you're going to front run some of that and maybe create some of that you otherwise would see. I think that's precisely, Steve, what you were talking about. And I think very much when we see airlines talking about lower prices, well, as a consumer of the airline, all right, I want to see it, right? I'm going to buy when I think prices look better. And so perhaps that will be a self-fulfilling prophecy in some ways that could help inflation as well. I think inflation data this week clearly giving the Fed some hope that maybe we are back on the right track, despite some one-offs and things like egg prices that are pretty easy to explain. And yeah, maybe it leads to a few more arrests at the border, but it also is one of those that, okay, I have some solutions there. Give us enough time to have some more chickens, lay some more eggs, and all of a sudden you kind of are catching back up to that demand. The other thing we had was some info on job openings and unemployment claims, and not massive moves there, but I think maybe encouraging signs on the opening front and some mixed data as well.
Sure. For the month of January, openings improved a little. One thing that I look at in that release, though, is the quit number, and we're still below the pre-pandemic level of the number of people who are quitting their jobs, which is sort of a sign of people being confident enough in the employment market that they can leave one job and get another right away. But the unemployment claims, they're still 38% below the all-time average. So a lot of the numbers in the labor market show maybe a little bit of weakening, but it's been so strong for so long that it's got to tire out sooner or later.
Yeah, you'd expect some of that softening for sure. Probably enter in a couple of weeks here with a little bit slower productivity growth, given some of the basketball that's going to be on TV for colleges. And I think, spring training winding down, Brewers season starting, it tends to be the best part of the sports calendar, at least.
Beer sales will be up.
Beer sales will certainly be up. So hopefully, even if we can't cheer on the markets, we have a little bit of an opportunity to cheer on some of the local sports teams. As always, we enjoy doing the program for you. We'll talk to you again next week.
Thank you for listening to Money Talk with Bob Landaas. If you have a financial question you want answered on next week's show, email it to moneytalk@landaas.com. To keep informed throughout the week, visit our Money Talk page at landaas.com.